All right, let's dive in. Today, we're taking a close look at one of the most talked about funds out there for income investors, the JPMorgan Equity Premium Income ETF, or as pretty much everyone calls it, JEPI. There's a ton of buzz around this one, so let's figure out why. So, the source material we're digging into today really kicks things off with a zinger. It asks, is JPI a wolf in dividend clothing? And you got to admit, that's a question that makes you lean in a little closer, right? Because on the surface, man, this fund looks like an absolute dream. And here's the reason why everyone's so interested. A headline yield that's often sitting north of 8%. I mean, in today's market, that feels like finding a unicorn. It's kind of like the financial version of a bottomless brunch. You just keep getting paid, and it seems like there's no catch. But that's exactly what we need to figure out. Is that massive yield actually too good to be true? Is there some kind of hidden catch, a financial hangover that we're just not seeing yet? Okay, first up, let's talk about the appeal. Let's get into what we're calling the 8% seduction. Because honestly, it's not hard to see why so many investors are flocking to this thing. At its heart, JEPI plays right into a really human bias we all have. There's just this comfort, this security you feel when you see actual cash hitting your account every single month. It's tangible. It feels way safer than just watching your portfolio number go up and down, hoping it'll be worth more down the road. So, how in the world does JPI actually pull this off? How does it generate that much income? Well, that brings us to the core engine of the fund. It's all about trading away future growth for cash right now. So here's the game plan in a nutshell. About 80% of the fund is just what you'd expect, a bunch of defensive, big-name U.S. stocks. But the other 20%, that's where the magic, or the trick, happens. It uses these complex things called equity-linked notes, or ELNs, to basically sell call options. Now, what does that mean? Think of it like this. They're selling the right for someone else to buy their stocks, but only if the price shoots way up. The fee they get for selling that right, that's called the premium, and that's the cash they turn around and pay out to you. Okay, let's make that even simpler. Step 1, they own the stocks. Got it. Step 2, they sell off the potential for those stocks to go on a massive tear. In exchange for giving up that lottery ticket upside, they get paid cash, right here, right now. And that, my friends, is the fundamental trade-off you're making with JPI. And this quote from the source material just nails it. It says to think of it as renting out your stock market's future growth for a quick paycheck. You get the steady rent check every month, which is great, but you're giving up the chance to ever own the whole building. But here's the thing about that trade-off. It's not free. It comes with some pretty big strings attached. The source we're looking at points out 3 major hidden costs you really need to know about. First, and this is the big one, your growth potential is capped. When the market is on a roll and everything is soaring, JEP's strategy means you're pretty much stuck on the ground. Yeah, you got that little premium payment, but you totally miss out on the rocket ride to the moon. And listen, over time, missing just 2 or 3% of growth a year, it has a massive impact. It absolutely demolishes the power of long-term compounding. The second cost? It's the fees. JPI charges 0.35% for its expense ratio. Now, that might not sound like a lot, but let's put it in perspective. A plain vanilla S&P 500 index fund like VOO charges just 0.03%. That means you are paying over 11 times more in fees for JPI. It's another constant drag on returns that are already capped. All right, and the third hidden cost comes from a place a lot of investors don't think about nearly enough: taxes. So a lot of the income that JPI spits out isn't exactly tax-friendly. You see that headline, 8% yield? Well, if you're holding JPI in a regular taxable brokerage account, that 8% can easily shrink to something closer to 5% once Uncle Sam takes his cut. Why? Because it's taxed as ordinary income at your highest rate, not at the lower qualified dividend rate. Now, sure, if it's inside a retirement account like an IRA, you can sidestep that tax hit, but you're still stuck with the capped growth we talked about. So what happens when you put it all together? You've got capped growth, you've got higher fees, and you've got this potential tax drag. What's the real long-term damage? Well, let's take a look at what we're calling wealth erosion in action. I want you to look at this number, $57,000. Let it sink in. According to a thought experiment in the source material, that's the potential opportunity cost. That's the money you could have had, but didn't, by choosing JPII over a simple S&P 500 fund with $100,000 over just 10 years. And this chart really shows you what that looks like over time. Let's say the S&P 500 averages a 9% return. Your initial 100 grand would grow to about $236,000 after a decade. Not bad. But with JEPI, if we assume a 6% effective return after all those costs, you'd end up with about $179,000. That huge gap between the two, that's your $57,000 opportunity cost right there. So after all that, you might be thinking, wow, so JPI is just bad? Well, not necessarily. The question is it right for you? Let's try to figure out where this fund might, and more importantly, might not, belong in your portfolio. It really all comes down to this one simple trade-off. What is your goal? Are you trying to maximize your long-term growth, or are you trying to maximize your income right now? A simple S&P 500 fund is all about growth. JP, on the other hand, is all about that monthly cash flow, but it gives up a ton of that long-term growth to get it. Here's another fantastic analogy from the source material. JPI is like a luxury car lease. You get smooth monthly rides, but never build equity. It's perfect, right? It gives you that consistent, comfortable feeling every month, but it's just not a tool for building serious long-term wealth. So look, JPI is a specialized tool. It's not a Swiss Army knife for every investor, but it could make sense in a few very specific situations. For example, if you are already retired and your number one absolute priority is getting the maximum possible monthly income, or if you're holding it inside a tax-advantaged account like an IRA. But you have to see, these are pretty narrow use cases. And ultimately, this all comes back to a really fundamental equation in investing. Your total return, which is the thing that actually makes you wealthy over time, is a combination of the yield you get plus the growth of your investment. Focusing only on that big, shiny yield is kind of like trying to fly an airplane with just one wing. It's just not going to get you where you want to go. And that leaves us with one last, really important question to ask yourself. Are you maybe confusing the comfort of getting that monthly cash flow with the real long-term goal of achieving true financial freedom? It's a critical difference, and it's something every single one of us needs to think about.